Now that the stock market has bounced at the end of July and going into August, a lot of the stock analysts that are coming out are bearish and saying that the stock market's going to not only test its 2022 lows, but make all new lower lows. However, other more bullish analysts believe that the bottom is in and that we're now rallying to new higher highs as the stock market recovers from what has been one of the biggest bear markets that we've seen in over a decade. With these two unbelievably opposite views, it can be really overwhelming to figure out which way to go. So in this video, let's get bearish and look at what happens if the stock market crashes in September, and let's get bullish and figure out what to do if it has already bottomed. You've probably heard the famous bears Michael Burry and Harry Dent warn that the market's going to crash epically going into the last half of 2022, and everybody should escape the 50% sell-off that's about to come. But here's the thing, they always say that, and at a certain point of Chicken Little saying the sky's going to crash, you have to start ignoring Chicken Little, because he's going to make you miss out on profits. However, even if the stock market doesn't crash below 2022's lows in the coming months, it's important to remember that the stock market does respect seasons, or what's called seasonality. In fact, let's take a look back at a few prior years to see what happens from August through October, because it actually is a consistently bearish time of the year. This is a chart of the S&P 500, and you can see that off of 2022's lows, the market has already rallied more than 13% from the bottom. And although that is a good rally, it's important to remember how far down it's come. If we come from the highs to where it is now, you can see that it's sold off 14% plus still, so it's not a bad place to open a position. However, if you look in the past, you can see that the market regularly sells off from August into October. If we look at 2021, you can see that there was a total sell-off of 5.87% from its high in August down to its low in October. In 2020, the market sold off more than 10.5% from its high in August to its low in October. And before you think that this is just a reaction to the pandemic, let's go back to 2019, where you can see once again more than 5% from August down to October. This one's even more appropriate to what we're going through right now. In 2018, the market sold off more than 20% from its high in August down to its low in December. And this was as a result of the Fed with Chairman Powell raising interest rates over and over again and scaring the heck out of the markets. While a lot of the recent media coverage believes that Powell demonstrated more dovish tones when he talked about how they were going to take more data into consideration, the reality is that Chairman Powell is more of a hawk, so the chances that we're going to see even more rate hikes into the future are very high. And if the market reacts anything like it did during 2018, then it's possible that more than a 5% sell-off could be in store. 2015 saw an even more dramatic sell-off, with the market selling off more than 11% from its high to its low. 2014's fall sell-off almost hit 10% from its high to its low, and even 2013 hit nearly 5%, selling off from August to October. And this pattern continues as we go further back in time. Almost every single year from August to October, you see a pretty significant sell-off of anywhere from 4.5% to over 12%, and sometimes even 20% plus from August into the end of the year. So it's incredibly important to keep this seasonality in mind when you start to plan your investing. And also it helps reinforce that you shouldn't feel a whole lot of FOMO or fear of missing out if you aren't fully invested right now going into the rally we've seen since the end of July. And while the seasonality happens more often than not, it's important to remember that no rule is without its exception when you're talking about the stock market. When you go back to 2017, you can see that there wasn't a sell-off. In fact, from August's high until the end of the year, the market only went higher, adding 4.26% onto the high of August. So it's always important to plan for both directions. What are you going to do if the market goes down tomorrow, and what are you going to do if the market goes up tomorrow? I am not a professional advisor or an investment professional of any kind. I'm just somebody who's been doing this for 24 years and have found strategies and techniques that work really well for me. As a personal retail investor, it's up to each of us to figure out what techniques and strategies work for us. So when I go over these in the video, it's not necessarily saying that this is what would work for you, but you might want to take them into consideration and then use them as a jumping off point to create your own buying or selling plan. When it comes to long-term investing, my time horizon is anywhere from 20 to 30 30 years. So when I'm looking at market movements, I'm not in it to be right. I'm in it to figure out what am I going to do if the market goes up tomorrow and what am I going to do if the market goes down tomorrow. And all of my plans rotate around that strategy and thought. So for me right now, I have nearly 30% of my portfolios in cash as a total sum of all of the investing that I'm doing. And that's quite a big cash hoard, but that's the way that works for me. But it also means as the market heads higher, I'm not looking to add to positions. Instead, I'd be looking to take profit. So when we're talking about a bear market rally, which is what we're seeing right now, I'm not looking at ways necessarily to increase my cash position. More importantly, I'm looking at ways to capitalize by taking profits on positions where I've added to them recently. For example, right now we're going to take a look at Apple with the ticker symbol AAPL. Apple is one of the oldest positions in my portfolio. I originally opened it in 2013 and it's incredibly successful. I have absolutely no investment capital in it and all of these profits that I've already taken out. However, that being said, I did buy some Apple in May around $142 a share. So when it rallied into its earnings report, I decided to take some profits because it had already outgrown the target allocation size for my portfolio. Not everyone needs to do this, but for me, I do have a set allocation size where I don't want a position to grow that much larger than that position size because I don't want the majority of my portfolio to be determined by a single position. And in the portfolio's case, the position size that was the maximum was 7.14%. And going into its earnings, Apple was 7.8% of the entire portfolio. So even though I thought Apple could do well in earnings, it was still time to take profits. I ended up locking in gains the day Apple was going to report earnings after the bell with a sell that locked in about 10 to 12% of profits on the shares that I had bought in May. For some people, they'd be really bummed because Apple ended up popping pretty significantly the day after, as you can see on the chart. However, that's not the case for me. Even after taking those profits, Apple is still much larger than the overall position size that I want for it. So it's still going to see a lot of upside, but at the same time, I'm peeling off profits as it goes up. I would consider my profit taking in Apple to be about a moderate way of taking profits, but let's look at a more conservative way of taking profits. In this case, I'm going to look at the Invesco Solar Energy ETF with the ticker symbol TAN. I added to my TAN position when it dropped down to its bottom here on May 12th. And I ended up taking profits in it over here on July 27th. Now, the price hadn't risen that much above my cost basis. However, since it had gone from $55.54 to where I took profits on the 27th, we saw a really big gain. In fact, off of its bottom to where it closed was a gain of 38.8%. So while selling at that point only reduced my per share cost by maybe 0.5%, the more important thing was capitalizing on a 38% gain from where I'd added to the position. For a more aggressive profit-taking strategy, we're going to take a look at Roblox with the ticker symbol RBLX. I added to my Roblox position back here on May 11th around $22 a share. And from that point, you can see that Roblox has seen quite a bounce from its bottom, nearly doubling from where it bottomed back at the beginning of the year. And while a lot of people might consider taking profits by this point, I'm actually going to wait until Roblox comes up to test its 150-day moving average, which you can see here. It's the gray line. If you look at the past when it comes to Roblox, you can see that when it does test the 150-day average, that's where it finds resistance and pulls back. So in this case, I have my next profit target, the one at $47.70, slightly below its 150-day moving average. If Roblox continues to tread water and doesn't try for the average, I will lower that price target as the 150-day average comes down to meet its price. However, I'm still going to wait until it tests that resistance point before I take profits. Roblox is a very small, more speculative position in my investments in play portfolio, so I don't have as much riding on the line if it does decide to flip around and test its bottoms from 2022. Let's say you're not like me and you don't already have a lot of positions already invested, and instead you either have a big cash position or you're not in it all. You're looking at the rally off the low, you're getting a bit nervous that this could be more like 2017 and not like the prior years. What if the seasonality doesn't hold and we don't see a sell-off? Well, the first thing you need to do is create a buying plan for whatever you're looking at. Whether it's looking at adding to index funds or individual positions, you want to take a look at where they've come from and where they might go into the future in order to design where you're going to add to your position. First off, where normally when I open a new position, I do it with a 50% allocation. If I was looking at adding new positions right now, I would do it with a much smaller allocation. In fact, 25% might be my maximum. I'd be more inclined inclined to start a new position with an even smaller allocation, starting with just 10% of the overall amount that I want to put to work so that we could see what happens in the coming months. If you're looking at a position like Apple, you could draw a Fibonacci retracement from its bottom in May all the way to where it is now, and it would give you different price levels of support. A good rule of thumb is to predict that a stock might pull back as much as 50% of the move that it's made, and that's what the Fibonacci retracement's giving us right here with $146.33. However, you can see that Apple regularly finds support above those points. So what I'd do is I'd use the close of this day at $147.07 as my first buy in Apple. I'd then look at a combination of the Fibonacci retracement and past levels to make additional buys. And you could see that $142.25 provided a lot of support on this day here, with its bottom at $142.12. After that, you can see that down at the 78.6% retracement, we do have a lot of support, but you might want to go higher. You might even want to go higher than this day and find a buy maybe around the low of this day, an up day at $137.65. After that, you can see that Apple pulled back consistently to these 2 days, and you might want to use the low of one of these days at $131.48. And after this point, I actually wouldn't buy at the low of May 2022. I would wait for Apple to break through the low and break to new lower lows if that happened. This is Amazon with the ticker symbol AMZN, and you can see it sold off really significantly to this low, but then ended up rallying more than 35% where it closed out the month of July here at $137.65. When you look at the Fibonacci retracement, while there is a little bit of support at the 50% line, you can see that it actually more regularly found support down here at the 61.8% line. So I'd probably make my first day in Amazon down here around $115 a share. After that, as we go down to the 78.6% retracement, you can see that it regularly broke through, and I'd probably use the low of this day at $109.05 as my next buy. After that, I would go down to the 100% retracement to its low of May of 2022 to try and find where I might find support in the past. And if you wanted to be a little bit more aggressive, you could either use the low of this day or even the low of this day as your next buy at $102.52. Well, that only gives us 3 buys, and if we were doing 10% allocations at each buy, that means we only have a 30% position. Given that there's so much bearish sentiment in the markets and that we don't know which way the markets would go, I don't want to have a big position on the line. I'd rather have Amazon take off, find out that we really did make a bottom, and then me buy at even higher levels than my cost basis. I want to be extremely cautious and conservative when it comes to all of my positions because we don't know if we've hit the low of this bear market or if there are further legs down like many bearish analysts are predicting. While my outlook for where the market's going to go into the coming months is bearish, I do believe we're going to see the seasonality take place. It doesn't affect what my plan is as we go into the future. There's no need to focus on being right. You don't need to have a thesis and say the market's going to sell off 40%. I'm not going to put any money to work. If you're like me and you're a long-term investor, it's more important to have time in the markets than timing the markets precisely. That being said, there's nothing wrong with trying to capitalize on some volatility. So for me, it's all about having a plan. What am I going to do if the market goes up tomorrow? And what am I going to do if the market goes down tomorrow? When you're talking about bear markets, it's always important to remember to use smaller quantities because we have no idea how far down or how far up we could go during all of this volatile movement. By considering all the options and making a plan in advance, you're more likely to ignore your emotions and be able to capitalize on the volatility of the markets. Instead of being determined by how much emotion you feel if the market's going up or down, you can just have your plan and stick to it. To learn more about long-term investing, check out some of my other videos here. Thank you for watching, and I'll see you in the next video.